Welcome back to my channel, Balance Sheets Matter. In this stock analysis video, we're going to be looking at 3 stocks I've looked at in the past and give them an updated analysis. Edward Life Sciences, Warner Brothers Discovery, and Costco. So I've done all these stocks about 2 years ago, so we're going to look at I'm going to bring up a little bit of the past analysis I did, what was good, what was potentially bad, and what has changed, so what we can see going basically forward with these stocks. So the first one we're going to look at is Edward Life Sciences here. Just to give you an idea, this is the line here is where I previously did the video. And I did mention in the video I had bought the stock on the previous dips here. And actually recently, in the last while, I did decide to sell it here just for a small little gain, although it did underperform the S&P 500. So I'm going to be giving you why I decided to get out of the stock and what has changed from the fundamental perspective. So Edward Life Sciences, the big thing with them is, you can actually see from my title, and we go back down, is EW stock really worth it at a 40 PE ratio? And in the past, I did think there was enough signs that it could justify going for a 40 PE, but there's now some things that have changed, and that's why I decided to exit the stock. At least it didn't crash down 80-90%, which does happen to some stocks. So for something that negatively changed for a company, could maybe consider it a bad pick. Therefore, it's not too bad. So the first thing, just keep in mind a little bit, about a $45 billion market cap. Overall, this company is very, very good financials. They have good growing revenue. They have the gross margins are quite high. They've been increasing in the long run over time, and though after 2022 they have decreased a little bit. Just something to keep in mind that if this does decrease more, it actually would put more pressure on the stock. And because of the industry they're in, they did have, it seemed like ever increasing operating margins. And a lot of my thesis before, which I did mention, is that they would be able to potentially maintain and increase these. Since a lot of, companies in the industries like Edward Life Sciences do, the more they grow their top line revenue, they don't have to grow their selling and general admin basically at the same rate. But that has now changed because before, when they had got it up to a 30% operating margin, and then even like a 34% in 2022, that started ticking down a little bit. And that's why I was saying, okay, I think it's, we want to see this maintain or potentially even increase a little bit. But now it's ticked down to a 27 and even a little bit below a 27. And you can see now there are 2 quarters here, the one ending December 2025 and 2024, but they did have definitely below average quarters. And if we look at all quarters in the past and we look at other Decembers here, well, before this was a 28% margin, and this one was a little bit on the abnormally higher side. But you'll see in all these other quarters here, there was not really very many of these lower than average quarters, and they've had 2 of these now quite close together, which is showing there might be some continuing pressure on their operating margins, and it may not increase in as much in the future, which I was expecting before. Other than that, the other financials are all good. It's, you can see net income has been growing great. The net margin is looking a little bit artificially low right now because there was this one write-off here. So it is a little bit higher than this, but compared to what they were doing before of these, definitely higher net margins, we really shouldn't be expecting that going in the future. And, it's because of that, the one write-off as well, their EPS is a little bit more abnormally down. And they do a few share buybacks, but you'll notice kind of on the balance sheet here is that the total stockholder equity does grow over time. And for an expensive stock, it's probably a good idea they, don't go crazy on the buybacks. And, in, retrospect now that the stock has been consolidating for a while, and if it actually does go lower, that'll turn out to be a very smart position because you'll see they actually have quite a big cash pile and cash equivalents sitting on their balance sheet here, which they haven't done anything with yet. And that's leaving them $6.7 billion in current assets and only $1.8 billion in current liabilities. So they are sitting on a big pile of cash, which is a big plus for them. And then really what's changed in the cash flow statement here, they did sell off one sector of the business that they feel wasn't in their core business, and they did do some smaller basically acquisitions. And there has been a little bit of repurchase of stock. There was a little bit more in 2024. And anyways, they decided to purchase a little less, but this does only a little bit more than the stock-based compensation. As you saw, the shares weren't reducing down at a tremendously fast rate. So really, why do I think the stock maybe doesn't garner this higher 40 PE anymore? So if we bring up the PE ratio here, and let's bring this down to 20 years so we don't get that blip. Maybe, yeah, no, 20 years, good. You can see basically, say in the last 10 years here, they were trading between, like even on the low side here, a 30 and, even a 72 PE ratio. And, now it's been basically more or less 10 years. Remember, the only reason this was really low here is there was that one-time sale of the business, makes their income look really high. They never really got to that lower P ratio. Pretty much in the last 10 years, the lowest P ratio has been about a 10, though in the past, they did trade at lower P ratios. And a lot of the reason why I believe they were garnering the higher P ratio was because of the margin expansion. And so if we bring up the operating margin here, you will see over this trend, there was this ongoing trend of basically just expanding margins, expanding operating margins. And some businesses are able to scale and actually do this for a long time. And the idea before was Edward Life Sciences is, this trend looks like it could potentially continue going forward. But now I'm getting a little bit skeptical about that. As if we bring up the operating margin again here, you're going to see that it actually has, decreased below these, previous levels here. So, well, I don't think that the operating margin is necessarily going to crash down a lot more. Who knows? It always could. That is actually a big downside risk. But if it does stabilize around here, this does break this expanding operating margin and therefore gross margin growth trend, which was one of the reasons it fetched a higher PE. So I think this is going to provide a little bit of a re-rating for the stock in its valuation. I would probably be looking at it more in the 20 PE ratio now. So if it does get down to a lower 20 PE, that's when I would actually start getting very interested in the stock again. Anyways, it's like, this is about the trend channel I had before. All I've done is I've kind of just double widened it. Sometimes stocks will do this. They'll go to a lower trend and they'll continue on the previous trend. So if it does dip down, I wouldn't even require that big of a dip. I think potentially could become attractive in the $50 to $60 range, and probably at that point it would be a low 20s PE. And I think at that point it would be like a very, very good value, because other thing you have to factor in is they do have a lot of cash on their balance sheet. They would be able to start buying back shares again, and with all that equity on their balance sheet, which is probably, once we factor out some of the intangibles and the goodwill, they still may have $7 to $9 billion of equity on their balance sheet. Well, the market cap is $45 billion. So anyways, that's my thoughts on EW. That's why I decided to just step out of it for now. And just if it does, like right now, it may not be a bad valuation. It could continue going up, but I really want things at a better deal, and I think it is going to get re-rated down. And I do want it, basically at a lower price, so there is a potential bigger gain to make in the future. So the next stock we're going to look at is Warner Brothers Discoveries. They are being acquired by, I believe it's, Paramount, and that's pretty much confirmed. So there's nothing to project going forward. But previously, when I did the video, it looked like they were making a very large loss. But I did point out that this actually, could be not too bad of a stock to buy, because on the free cash flow front, let's get down to the cash flow statement here, they were actually showing, quite a strong free cash flow, which was putting them maybe at about a 5P ratio. Another thing I did mention, though, is that because of the writer's strike, they probably weren't spending as much money as they would be in the future, and we may see the cash flow go down a little bit. And I additionally mentioned that I did want to start seeing them pay down some debt, since if you look at their, the total equity here, it has basically, ticked down in the years because they did do a lot of write-downs, and that's why their EPS was negative. Well, their actual free cash flow was positive. And the big thing is, they have all these, assets on their balance sheet, but, what are they really worth? We don't really know how much they are. And, there's a lot more that could be written off. And at the time here, you can see they did have a lot of debt, $48 billion. And to my hopes here, they actually did start paying down the debt quite aggressively. As you go from 48 to $32 billion, that is, actually tremendous improvement in paying down the debt. So these were things I did want to basically see start happening in Warner Brothers Discovery. And WBD. There we go. Warner Brothers Discovery. And when I had done the video, I did it around here, and I said I would want to see the stock, at least base. It could potentially drop a little lower, which, that's all that basically happened. And I wanted to see what their free cash flow once would stabilize at the future and get them pay down a little bit debt. Otherwise, and then you could kind of reanalyze in the future going forward if they're going to be a good value. You're not seeing any big depreciation, and that would kind of be the time to step in to buy it because it could be a deep value then. And I think that actually did play out very accurately. I didn't necessarily was guessing they were going to be acquired. That is a way that kind of gives a really big, pump up for the stock. But we did see all those factors basically start to happen. Is we did see the cash flow, like I previously said, normalize a little bit, and we can say, hey, that's basically still a good positive, cash flow going forward. And they were able to, pay down a lot of debt. So that, is a good sign. The company did get in a lot better state. And anyways, unfortunately, I never took a position in this. It just kind of, went off my radar. But if I actually did reanalyze the stock like I had previously said, it would have been a very good opportunity to get into it about here after you saw the basing. And there was some time that passed, and they did show some fundamental improvement. And if you did happen to do that, you actually could have made some, quite decent gains. But, there's nothing to project going forward since, they're being acquired. And the last stock we're looking at is Costco. So this one, I did an analysis basically here. And, well, the stocks ran up, quite a bit. And I can't necessarily say I was bullish on Costco before. The one thing I mentioned, Costco is a very, very high company. When I did the analysis, they were 40 PE. Now they are 51 PE ratio. And there's really nothing to go over with all the details of Costco's financials, but I will even mention their, return on invested capital is actually getting better and better. This is a very, very strong company, but they are relatively going to be a slow grower in the future, at least from the revenue side. But why have they been getting this really high PE ratio? Well, you can see their gross margins are very, very steady and not increasing. But the one thing that is being increasing quite aggressively is their operating margins. And when I did the video, that was, I think, about, more back here, when we were seeing it about 3.35, I was saying, I don't see how they're going to be able to continue basically increasing these in the future because, they operate, retail stores. There's a certain amount of overhead employees that you need for that. And you can't basically indefinitely, cut that and create those efficiencies with this type of business. But Costco, in the short term at least, has continued to prove me wrong. They've actually managed to keep those operating margins growing. You also just can see that they are making some reasonable interest income too, since the interest rates are higher, which is a lot higher than their interest expense, kind of telling you they got a good balance sheet there. And, that's also at the end of the day helped drive their, net margin growth up. So we're looking back here, they had a 2.6% net margin, and now they're almost at a 3% net margin. So if they continue, expanding your operating margins, this is what fetches higher, basically, multiples for a company. And that's one of the reasons that Edward Life Sciences before traded at very high multiples. They were basically having their operating margins grow. But when that changes, stocks usually get re-rated to lower levels. So Costco, I will hop into the interactive chart here. And we didn't really need to look at any of the other stuff. You can look at my last analysis. It, really hasn't changed anything else there. And you can see that the rate of growth they're expecting here, which is, not very quickly. It's about, $20 billion per year. But as they get bigger and bigger, that's like, a lower and lower, basically, trend. And you'll see a lot the PE here. It's really just been multiple expansion, which has drive the majority of Costco's growth. Back here, and this is honestly a type of level that I think Costco should be worth, is in that, 20 to 30 P ratio. And, that's kind of what they had traded for in the past. But, over the time here, especially in recent time, this multiple has just managed to balloon up. And really, why that is, as I was basically saying, it's the margin. So if we bring up the margins here, we can look at the operating margin. And let's get rid of the P ratio so we can see that nicely. And you can see the operating margin has basically been going up with the stock. And this is one of the reasons why I do look at margins so much and the trends they do, because this determines a lot of, what the valuation they should be. And if you can use reasonable assumptions to, forecast maybe where the operating margins are going based on various factors and other stuff, you kind of can get an idea of where the stock will be going. Now, if we look at the larger history here, I was looking comparing back to these margins here. They had high margins after 2000s. The margins basically contracted a little bit. E contracted, as we saw before, and then they were able to expand them. And when I did the analysis, I'm like, well, they're already at or even a little bit above these previous high margins, and maybe we're going to see them basically stabilize, which is going to garner a lower PE. But they proved me wrong, and they continued expanding them. So I think the philosophy of my Costco analysis basically still holds true. I was wrong that it was going to be really hard for them to expand their margins, and they were able to continue expanding them, and therefore, the stock basically went up a lot. But I will tell you for sure that when they stop expanding their margins, and if there's some contraction, the stock does potentially have a lot of downside. You can basically see on the chart here, this long-term trend basically I have is there has been some very large declines in the past. And before, this is where they had some peak margins. And you can see how long they went sideways for. After 2000, they hit their peak margins here. This stock was, sideways basically for a decade. And, now where we are here, there's, we're getting kind of up into potentially one of these large trends again. There is a potential, good amount of downside or a lot of, just stock working it off, like itself off sideways if they aren't able to keep those operating margins expanding, which, I didn't think they could expand before. And, who knows, maybe they're going to be able to continue to do that. I personally don't think they will. Costco's not a stock I would, actually want to short, but it's one I would just sit on those sidelines, and maybe in the future, if the operating margins do contract, we will see quite a more attractive price to buy it in the future, although it actually did end up being a good price here from the pop-up it had before. But as I pointed out, that was mostly just multiple expansion. So anyways, there's the stock analysis on the 3 different stocks there. Overall, I think what I was looking at in the past, there was some, good analysis for it. And I was generally right about what I was saying that was relating to the financials. The overall projections on, Edward Life Sciences, stabilize or maintain the operating margins versus Costco, they would plateau and potentially decline. Apparently, I was backwards on those. You can't predict the future. Maybe if you have some deeper insights, those specifics of the stock, you could potentially see where those little things are going forward and get a more accurate projection. But you can see the overall philosophy of looking at those concepts, were relatively accurate and, have actually helped dictate where the price stock has gone. So, make sure to subscribe to the channel if you want, more stock analysis videos in the future, and like the video, and I will see you in my next stock analysis video.